Have you ever wondered about the current state of theaters, malls, and big shopping complexes? In a world where online platforms are becoming increasingly prevalent, these physical spaces continue to hold a certain charm and attraction. But how do they manage to stay afloat, especially in these challenging economic times? The answer, quite often, lies in funding. Now you might wonder, what is funding? Well, it's the financial investment that these establishments need to get off the ground and continue running. Two of the most common types of funding are angel funding and venture capital. Angel funding is typically the first form of financial backing a business receives. It comes from wealthy individuals known as angel investors who provide capital in exchange for a stake in the company. Think of it as a loved one lending you money to start your dream venture. Except in this case, your loved ones are successful entrepreneurs or business people who believe in your idea. On the other hand, venture capital comes into play when businesses are ready to take a leap but need substantial financial backing. Venture capitalists are often firms or companies that invest large sums of money in a business in exchange for equity. They usually step in when the business model is proven, and there's potential for high growth. In essence, both angel investors and venture capitalists provide funding, but they come into the picture at different stages and offer varying levels of support and involvement. To summarize, theaters, malls, and big shopping complexes often rely on external funding to maintain their operations and continue providing the experiences we cherish. This funding typically comes in the form of angel funding and venture capital, each with its unique features and benefits. Angel funding is the initial financial boost, coming from wealthy individuals who believe in the business idea and are willing to invest their own money. Venture capital, on the other hand, is a more substantial investment coming from firms or companies, usually when the business model has been proven and there's potential for high growth. So, the next time you visit your favorite theater, mall, or shopping complex, take a moment to appreciate not just the experiences they offer, but also the financial backing that makes it all possible. These establishments are more than just brick-and-mortar buildings. They are dreams turned reality, thanks to the support of angel investors and venture capitalists. Now, we've talked about the importance of angel investors and venture capitalists in bringing our favorite establishments to life. But what's in it for them? Well, investors, whether they are angel investors or venture capitalists, expect a return on their investment. They're not just handing out cash out of the goodness of their hearts. They're making a calculated risk with the expectation of a profitable return. The average return expected is typically between 15% to 20% on the yearly profit margin. Furthermore, these investors typically have an exit strategy in mind, which is usually between 3 to 5 years. That's the typical time frame in which they hope to see a return on their investment, either through selling their stake in the business or through an initial public offering, IPO. So, investing in businesses is not just about providing funds, but also about making a profitable exit. It's a complex dance of risk and reward, all in the hopes of turning a promising idea into a profitable reality. As we have seen, investors are looking for a profitable return on their investment. But how does a business convince investors that they are worth the risk? This is where valuation and pitch decks come into play. Valuation is a crucial part of attracting investors. It's the process of determining the economic value of a business or company. One common method is the discounted cash flow, DCF methodology, which estimates the value of an investment based on its expected future cash flows. This gives investors a clear picture of the potential return on their investment. But it's not just about numbers. A pitch deck, a concise presentation that outlines a company's business plan, is equally important. This presentation is usually given to prospective investors. It includes information about the company, its products or services, market analysis, financial projections, and the team behind it all. Creating an effective pitch deck is an art. It should be clear, compelling, and concise. It should tell a story about your company and why it is a good investment opportunity. Remember, investors see hundreds of pitch decks, so yours needs to stand out. With a solid valuation and a persuasive pitch deck, businesses can increase their chances of securing the funding they need. It's not just about having a great idea, but also about convincing others that your idea is worth investing in. In our next scene, we will delve into the details of how to create a perfect pitch deck that can wow your potential investors. So, stay tuned.